And welcome to ETF Edge, your go-to place for everything ETF. I'm your host, Bob Pisani. We have three of the very best people in the business joining us. We always have this. That's what you get here with ETF Edge. Doug Yones is the head of exchange-traded products over at the New York Stock Exchange. Todd Rosenbluth is the senior director of ETF and mutual fund research at CFRA. And Sal Bruno is the CIO of IndexIQ. Gentlemen, thanks very much for joining us. Doug, I want to start with you. I wonder if you could update us on the state of the ETF business. You do a quarterly report on the ETF business. This only goes through the first quarter of this year through March, but some impressive numbers. We still have 2,300 ETFs in the United States. I'm quoting from Doug's report, folks. Assets under management, $3.7 billion. We're close to $4 billion. Doug, give us a little update on where we're at. I know there's been a little bit fewer ETFs in the last few months. Some funds have closed, but overall, I still see on net continued inflows and continued high interest in ETFs.
Yeah, it's been a very active market, Bob, and that, I don't just mean volatility. With respect to new products launching, we've had 87 ETFs launch year to date. Net cash flow for the year close to $188 billion in ETFs. So even with the significant market swings, it's been a positive year. New asset managers entering the space, like BNY Mellon is a new asset manager. We're expecting Allianz to enter in the next few weeks. So with over $4 trillion right now sitting in the U.S. ETF market, there's still a lot of greenfield opportunity for new managers to come in. And regardless of a volatile market, the reality is that ETFs have performed exceedingly well. In fact, they've brought in net cash flow every single month. So even in the midst of the sell-off in March, we saw equity ETFs bring in probably about close to $18 billion that month. So ETF investors certainly wholehearted and certainly still active regardless of market conditions.
And this is why we continue to see new entrants into the market, like BNY Mellon and Allianz. People a couple of years ago said, oh, everything's been invented. It's like physics 100 years ago. We've invented everything. What else can you do? And it turns out, even if you have a product that's essentially the same thing, Schwab proved this very definitively, I think, a few years ago. They have an active base of investors in their own camp. Why let somebody like a Vanguard or an iShares capture that when you can essentially do the same thing? So I certainly think, Doug, it's very smart. I wonder if you could update us on this whole ANT product, active non-transparent ETFs. This was a hot thing in the beginning of the year. And even though a few firms have started doing it, creating ETFs that are actively managed parallels to their mutual funds, I don't think it's caught on in any big way. Can you give us 20 or 30 seconds on where we're at on that? Because it was a hot topic a few months ago.
Yeah, I know we're pretty early in 2020, but I will say this could be the year of active. And what I mean by that, over half of the ETF launches year to date have been actively managed ETFs. Now, the reality is the majority of those products are still showing their holdings every day. As you mentioned, though, we have two products year to date that have launched in this semi-transparent structure. They do a quarterly holdings release, and about half of the models are now approved. So active managers that are thinking about coming to the space but don't want to show their holdings every day, we're really engaged now with a lot of conversation about bringing those products to market. The reality is active is performing. We're seeing net cash flow into those products, even just looking year over year. At actively managed ETFs, about a 36% increase in assets under management. So for those investors that are looking for an active structure, they do seem to want to access that in an ETF wrapper. And for the issuer of active management, the ETF wrapper offers a lot of benefits. They tend to be lower cost and they offer global distribution. So there's a lot of reasons on both sides of the fence why an active manager or investors want to be involved with an ETF wrapper.
Okay, Todd and Sal, let me bring you two in on this. Just a quick comment from you. I know, Todd, you're a very active observer of this whole space. We're approaching the half-year mark, and what's amazing to me is, despite all of the volatility, number one, ETF products have held up very well. Yes, we had a very specific issue around the oil ETF that had to do with the fact that you're owning futures products, and this is a very separate part of the whole ETP space. I want to separate that a little out. I'm talking about the equity products out there, even the leverage and inverse ETFs. What struck me is they all held up remarkably well. And I wonder if you could quickly comment on that and what it tells us. Secondly, on the corporate bond space, tremendous stress in that area. We did have some differences in the net asset values there. and the prices of the ETFs. But even here, it seems like the ETFs are on the right side of things. Just give us a brief overview of where we're at here, Todd.
Yeah, Bob. So what we've seen is that investors actually flocked to ETFs during the market volatility that we covered earlier. Doug talked about at the end of the first quarter. And we've actually seen money flowing back in to fixed income ETFs. They've actually been the more popular product, whereas we've seen outflows in the past month to S&P 500 index-based products like SPY, IVV, and VOO. It's rare to see those three ETFs together see outflows when the market's been up. But it's been high yield. It's been investment-grade products that held up exactly as they should have during the market volatility. And now with the Federal Reserve looking to get into this space, or actually having ETFs to get stability, we've seen investors going into that. Real quickly, if I could, we're seeing active ETFs actually in the transparent way in the second quarter that Doug talked about. So JP Morgan entered with active equity ETFs about a week ago, and we've seen smaller firms like TrueMark actively manage ESG products. So we are starting to see firms, including Sal's firm, that are offering actively managed ETFs.
Okay.
Yeah, Bob,
and we're getting a little crackling. We're getting a little crackling in your microphone there, in your sound system there. So we'll see if we can improve on that. Sal, did you want to step in here?
Yeah, I was going to just jump in with a quick point. I think it's interesting that ETFs have taken in assets, and we've seen flow and a lot of trading volume. It's easy to remember because it seems like time it's just going amazingly quickly. But it's only been 8 or 9 months ago that we go back to October, and we actually saw all the TD Ameritrade, Schwab, E-Trade, and others drop trading commissions down to zero. And I think that was actually a really interesting development that we lose sight of. So for investors in this point in time in the market and seeing the volatility and trying to react nimbly, you removed all the transaction costs. Of course, you saw the bid-ask spread and market impact potentially. But in terms of hard costs, those went away. So I think it enabled investors to move even more quickly throughout these more volatile times into and out of ETFs. And then they're trying to trade, equities and trying to position themselves well. So I think that's kind of an interesting observation and point.
Do you think that the fact that we went to zero commissions on stock trading and many ETFs encouraged more active trading, Sal?
I think it not necessarily encouraged it, but enabled it. And I think investors were looking in this volatile period where you saw, stocks fall from the February highs right around President's Day to late March where they bottomed and then came back. I think people who were looking to be nimble found that they did not have to worry about transaction costs as an impediment. So I wouldn't say it encouraged it, but it definitely enabled it.
Yeah, I'll add to that, Bob.
Doug, what do you think?
I think
Doug, what do you think of this?
Good point. The reality
Go ahead, I'm
is
sorry.
Individual investors, hedge funds, all the way through institutions, insurance companies, when the markets were swinging so volatile, right, day over day, we were seeing them really engage with ETFs. And, the fixed income was a very good spot to really highlight because we've had over $55 billion in net cash flow in fixed income ETFs year to date. But we saw ETFs trade the way the fixed income markets were trading. When there was a sell-off in fixed income, we saw sell-offs in ETFs. And those ETFs provided a bit of a buffer for the underlying securities. And I think that's one of the pieces that the market gurus get into. But individual investors, if you want to tap into, let's say, high-yield bonds or muni bonds, it can be very difficult in times of stress to trade the underlying bond. Yet individual investors on some of those platforms with zero commissions had the ability to go in and trade, whether it be they wanted to own more exposure or reduce their exposure. They could do so through ETFs with zero commission at a time when the underlying bonds were struggling to trade.
Yeah, I think the whole thing that happened with the bonds, with the LQD trading at times premium, times a discount to net asset values, exonerated ETFs. We saw this with Chinese ETFs earlier in the year where the China market was closed and the ETFs here in the United States traded perfectly well and very accurately reflected ultimately where the pricing was going. So I'm hopeful that this will accelerate electronic trading of bonds or whatever we can do to get quicker, more accurate bond prices because the ETF bonds, the corporate bond ETFs certainly were able to figure that out. I want to move on here because we can get into this discussion for a long time. Todd, maybe you can comment on this. The U.S. Senate passed a bill this week that would result could potentially result in the delisting of certain Chinese securities from U.S. exchanges. It seems to me that's going to have a very big impact on a lot of emerging market ETFs. Of course, we talk about EEM, which is the main one. That's 30% China. But VWO, IWMG, big global funds that are out there where China is heavily represented. Todd, any thoughts on this? Here we have politics sort of intruding, politics and global issues intruding on the entire global structure of ETFs and indexing, frankly.
So what we find is that China is roughly 40% of most diversified emerging market ETFs. You mentioned IEMG, VWO, EEM. State Street has a product, which is SPEM. The weighting in China is roughly about the same. But most people tend to think of companies like Tencent or China Construction Bank or China Telecom, which are domiciled and traded in either China or in Hong Kong. But what is easily lost, I think, on many investors is that Alibaba and JD.com, among others, trade on the New York Stock Exchange or the NASDAQ. So these are those companies that could be impacted. If they're delisted, obviously they would no longer trade here. They would no longer be in the index. So it's important to make sure investors look inside and know what their exposure to China is in their emerging market ETF, as well as where they're getting that exposure. They can, of course, also find some smaller ETFs like FRDM that actually has no Chinese exposure due to the freedom weighting that's used for that ETF.
Yeah. Doug, any thoughts on this? Obviously, there's also some political overlays around this. My attitude is we all know about the problems associated with China. We all know about the problems with the auditing of Chinese firms and how difficult it is. We all have a feeling, I think, that there are times when the Chinese firms are not forthcoming adequately for U.S. investors. We've seen numerous problems associated with this. And yet, if you know, it's one thing that you already know all this. It's like you're a qualified investor. You know that there are risks going in for China, but you want a globally diversified portfolio. I don't know. What's the right way to look at this? Doug, any particular thoughts on this?
I think it's important we all take a step back and think about the overall global markets, right? I think we'd all agree America has the greatest capital markets, the most liquid. And so at any kind of regulation, we always want to be sure that we're balancing both investor protections alongside investor choice. And when we think about the Chinese companies from an ETF perspective, as mentioned, right, there are quite a few ETFs that cover the Chinese companies, but it doesn't always necessarily state where that company has to list. And so the net impact on ETFs could be a bit muted. And what I mean by that is, let's say a company was currently listed in the United States. If it were to move to another market, it might just stay at the same weighting, same percentage, and within that ETF, and the ETF is now just buying and selling the Chinese company on another market. And so the net impact to ETFs, I think, could potentially be muted, but the net impact to the overall global capital markets, I think that's real and something that we want to make sure we're weighing and balancing before we make any major changes.
Yeah, and Bob,
I agree on that.
On that point, I think it's interesting to look at this as a capital markets issue. I think it's actually more of a political issue because, as you mentioned, nothing is really new. We all know about the Chinese accounting issues and their lack of transparency sometimes and the audit issues. But it's coming up now during a time period where we're seeing increased tension potentially between the U.S. and China. And to me, this is just kind of one of the bricks in the wall there. And so we're looking at, obviously we had trade weighing on us in 2019. We have the coronavirus and the political ramifications that are going on. And just today we had the U.S. State Department basically saying that Hong Kong is basically no longer autonomous from China. So I think we have to look at this in a larger picture and what it means, not just for ETFs, but I think it's a political bargaining chip, if you will, between the administration and how they approach China.
Yeah, good point. I just want to move on and hit a couple of other topics. And Todd, you were mentioning know what you own. You're on that theme all of the time. I just want to highlight what happened to the low volatility ETF. You know, these ETFs, they rebalance regularly, many of them quarterly. Low volatility was very popular in the last year and a half. It rebalanced just recently. Now, you think low volatility, you think like, oh, that's got to be utilities, right? Or REITs or something like that, or Procter & Gamble or consumer staples. And well, it was. It turns out they rebalanced and they got rid of most of the utilities. Now they own Amazon and they own eBay. And it sold the utility, the Con Ed. It sold Con Ed. And McDonald's used to be low volatility. Apparently, it's not anymore. And Todd, I found this very amusing because this illustrates your point here. So REITs and utilities, it turns out they weren't so low volatility back in March and April. When the rebalancing came in, they threw out a bunch of them. And low volatility is now more associated with healthcare, essentially, and some of the consumer staples names. Todd, I guess this makes sense. I don't know why we think of Amazon as low volatility now, but...
Well, Amazon held up better than the broader market, I guess, is the takeaway, and for the fact that people are using it more than they ever did beforehand, given that we're staying at home. But you're right. So this used to be, SPLV used to be considered a real estate and a utility heavily weighted product, and it rotated away from those. Those stocks did not hold up during the most recent quarter as part of the rebalance, and the stocks that held up much better were primarily in consumer staples and healthcare. So still defensive sectors. We've just seen a rotation from two defensive sectors to another two defensive sectors. What also caught my eye is that this ETF now actually has more exposure to technology stocks. It's now 9% of the ETF than real estate and utilities combined. SPLV has always been underweighted towards the growthier sectors like technology, unlike USMV, which is iShares minimum volatility ETF. iShares uses more of a sector constraint approach, so 20% is normal to find within USMV to the technology sector, and under 10% is common to find within those defensive sectors. So these ETFs rebalance. It's important if you own them to make sure you look inside and use third-party research to be able to help you validate that.
Yeah, I guess Todd, what's the conclusion here? In a high volatility environment, low volatility doesn't necessarily outperform. I mean, what is the conclusion we could have here? Presumably people own low volatility because they make an association. If the market gets crazy, these stocks will move less. And it turns out this assumption is wrong. I'm trying to figure out what's the teaching lesson here from this.
Well, I think the teaching lesson is that if you're buying a smart beta ETF, don't just buy it and hold it and forget about it, but make sure you understand. So it's now owning what are the most recently low volatility stocks. So it's actually doing what you'd want it to do. It's rotating away from what had been previously low vol, but then spiked a bit. There's no static in low volatility.
But after the fact, it's doing it. You almost want actively managed low volatility on a daily basis to figure this out. I mean, my point is, people bought this thing or used to buy it because they thought low volatility would outperform in a high volatility environment, and that did not happen here. Okay, so it sort of makes you challenge your assumptions about what you own some of these things for. They don't work the way you actually think they may necessarily work, maybe because the assumptions were wrong. Like the idea that utilities would always be low volatility turns out not to be true. You see? So
well, Bob,
I don't know.
That's really interesting because we're looking at it through the prism of the equity markets and the way that a lot of these low vol in the equity markets are looking at historical volatility. And you're right; they're not necessarily predictive of future volatility. You know, we've worked with S&P to create an index and an ETF that actually applies a similar concept to the high-yield corporate bond market, which in some ways has parallels to the equity market, but it actually uses forward-looking information like credit, option-adjusted spreads and duration. And what we find there is it actually does really well during periods of volatility, heightened volatility. Some of it is from security selection, but a big piece of it is actually coming from the sector selection. And we've done research looking back, over 20 years, and we found that it's a consistent theme. So going back to the early 2000s, media and telecom companies were actually underweight as we had the TMT crisis. Autos and financials, the great financial crisis. More recently, it's been underweight things like energy and financials and overweight healthcare and consumer staples and communication services. So it is a little bit more forward-looking, and maybe there are clues that you could take out of the high-yield corporate bond market that maybe you could actually apply to equities. You can invest directly in the high-yield corporate bonds as a way to potentially dampen volatility.
Gentlemen, I'm going to have to leave it there. We've hit on a lot of subjects, but I have three of the best in the business, so I can throw anything at these guys, and they can come back with a proper answer. Thanks very much for joining us, everybody. That does it for this week's ETF Edge. I'm your host, Bob Pisani, and my thanks to Doug and to Sal and Todd for joining us today. Really appreciate that, guys. Thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same place, same time. Everybody have a healthy and happy and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.